Corporate Finance Practice Problem using Excel. Profitability Index. Get ready, it's time to take your chance with Corporate Finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we are in the Practice tab as opposed to the Example tab. The Example tab, in essence, being an answer key. Information, left-hand side, populating that information, calculating in the blue area on the right-hand side. Similar scenario to prior presentations in that we're going to have two projects here, and our goal is to evaluate whether we want to invest in them. Typically having an investment that's going to be the initial investment we put into place, and then having returns on that investment in multiple years into the future, thereby taking into account time value of money, or time value of money being important to make a logical decision. The two kind of calculations that take into consideration the time value of money very well being the net present value calculation and the internal rate of return calculation. We're going to add to that now the profitability index, which is often useful if you're comparing two completely different projects where the initial investment, for example, is a substantially different amount. So you're comparing very different kind of projects. This could be an added resource that you can basically add on to basically the net present value calculation. Remember that the format of these calculations could be the initial investment, the initial down payment. It might be for equipment. It might be for a project. It might be for some kind of investment that you're putting money into so that you can get returns into the future. It might be inventory, all those kind of initial investment kind of things so that we can then generate revenue on it in the future. A, we're saying has 250,000 and it's going to produce then, we're projecting these cash flows from years 1 through 4 into the future. And then B, we're saying is 450. So you'll note there's a substantial difference in the initial investment on it. And then we're thinking that these are going to be the future cash flows for B. Our hurdle rate, or our discount rate that we're going to use, is the 10%. So that's going to include not just basically interest in terms of the time value of money, but the rate of return that we want to be receiving. The cost of capital, the rate of return, the hurdle rate, the discount rate. That's what we have here. So therefore, typically, if our net present value is above 0, then we would take on the project if we had the money to put into the project, given the fact that would mean that the return is greater than the 10%. But if we're deciding between one of two projects, both of which are over the hurdle rate, the discount rate, and we can only put money into one or the other of them, then we might do further analysis, for example, seeing how far above 0 these calculations are, and possibly look at the internal rate of return, and then adding on to, in this case, the profitability index. So our starting point will be the net present value calculations as we've seen in the past. So I'm going to start off with 0, 1, 2. I'm going to then autofill that on down, selecting these guys and autofilling them down. And then we're going to go to the alignment and center. We'll then say this is going to be the total, and then pick up our payments. So it's going to be negative 250. I'm going to represent that as a negative on time period 0 because that's an outflow, and then all the inflows as positive numbers. I'm going to pull them using cell references into our data over here, into our worksheet, and then autofill them down. So there is our inflows. Then if I was simply to add them out, not taking into consideration time value of money, underlining first, underline, and then summing it up. Sum would be these items. So we got the 220. So that'd be the 220 if I don't take into consideration time value of money. Now let's do the time value of money calculation. Remembering that when I do this, I'm not saying just this is the cost of inflation. We're taking into consideration the opportunity cost, our required rate of return. So if this comes out to 0, it doesn't mean like we're not making a profit, because and the profit is in the discount rate or the required rate of return. Typically that's kind of what we're assuming. That's our cost. So we're going to say this is going to be then negative present value shift 9, negative present value, my fingers are on the wrong key, shift 9, rate 10%. I'm going to make that an absolute reference so that we can then copy this down. I'll do this more quickly because we've seen these calculations in the past. So I'm going to say F4 on the keyboard, $sign before the B and the 11, comma, number of periods. I'm going to pick that up over here, the 0 on the left-hand side. Note that I'm not hard coding or just typing in 0, but I'm picking it up over here. So when I copy the cell down, it will appropriately take the 1 on the next cell down. Comma, comma, because it's not an annuity but present value of 1. Then I'm picking up the 250,000 and enter. Very boring result given the fact that we're just at the 250 because we're at time period 0. But if I then autofill this down, grabbing the fill handle and dragging it down, we have the appropriate calculations here, hopefully. Double clicking on one of them to double check it. We are picking up the 10%. It didn't move down. It's picking up the proper amount and the proper period, so it looks good. So the 30,000, if we discount it back by 10%, which includes our return, is at 118, 182. The 110 coming back is at 90,909, and so on. Underline the last one, font group underline. Summing this up equals the SUM, sum of these items. So we have a positive 124,380. So the fact that it's positive at all means that we cleared the hurdle rate, or the 10%, which would include our return, and it would be something that we would say, yeah, that would be something we consider investing in. But if we have two projects that both clear that, and we can only invest in one, we might have to do further analysis on it. Let's do the net present value calculation down here, which would be the net present value, shift 9. We can pick up the rate, and then comma, and then I'm going to pick up the values, everything other than period 0, which would be these 4 items, shift 0, closing it up, and then plus the period 0 or the negative outflow typically, which is that negative 250. I'm going to say plus that negative number because it's a negative in that sign. So there's the same 124,380. All right, and then if I compared that to project B, and then we'll do the new thing, the profitability index, profit B then has this big cash flow up front. So let's do the comparison 1, 0, 1, and so on. Copying that down. Copy that down with the autofill, centering it, alignment, and center. Outflow is going to be that 240. Whew! I don't know. I don't want to put the outflow 240. But what if we make a lot of money by doing it? Because we're going to get 230 in year 1, and then if we copy that down, there's the inflow. If I was going to sum that up and say, let's sum that up and total that up, we're looking 300,000 profit, not taking into consideration time value of money. So, it might be worth it to put that 450,000 down, but I don't know. That's a lot of money. This other project, I only got to put down 250,000 down. So, but I make more money in total. What if I time value it with the 10% discount rate? What's that look like? We'll say negative present value, shift 9. The rate's going to be the 10%. I'm going to make that an absolute reference, F4, $sign before the B and 11, comma. Number of periods is going to be that 0, comma. Future value 450, which is the same amount, but when I copy it down, autofill that down. And then I'm going to double check by clicking somewhere that we are picking up the 10%. Everything looks like it's calculating properly. Underlining the last number, font group underline, summing it up equals the sum. And summing that up, it says, yeah, we are clearing the discount rate of the 10% because it's a positive number. And if I was to compare these two projects, I do have a bigger number here, so it's clearing by a larger amount than the first project. So under that analysis, I would be picking project B, but I'm still hesitant because, that's a big difference, like 250 versus 450, on that initial investment. I mean, like I want to take into consideration the size of the project, and that's where the profitability index might help to make a decision that has different sizes. So let's do the net present value again. We could say this is going to be equal to the net present value, shift 9. We're going to pick the rate up at the 10%, comma, and then the values are going to be these items. And then we'll close up the brackets and we'll pick up the negative plus the negative 450 up top and enter. So there it is, calculated once again. So now I'm going to go, okay, yeah, this one's still better, but what if I do the profitability index? Because I'm trying to convince myself not to do it because I really only want to put down 250, right? So I don't know about the 400. So now let's try the profitability. Let's see what that says. So that's calculated by taking the investment, which is going to be the 250,000 in this case. And then we'll pick up the net present value. We're going to add that to the net present value, which is going to be then what we calculated down here at the 124,380. I'm going to underline that, font group underline, and that's going to be a subtotal, subtote, and I'll indent that, alignment indent. Going to sum those up in the outer column equals the SUM. So we got the investment plus the net present value at the 374,380. We're going to compare that then to the investment of the 250, meaning dividing out. So we will then underline that, font group and underline, and that's what we're going to have for our profitability index, also known as the PI. The PI, and oh, what happened there? And so that's going to be equal to the 374,380 divided by the 250 investment. Adding a couple decimals, numbers, add a couple decimals, we're at the 1.5. Let's compare that then to what we get down here with the second project, where the investment is the 250, or now we're at the 450 investment. And then we got the net present value, which we're going to add to it, adding the net present value, which comes out to the 148,818, underlining that, font group and underline. That's going to give us our subtote. Oh, and we'll sum that up, equals the sum in the outer column. We're going to compare that number to the original investment. I'll indent the subtotal just to make it match what we did before. Investment was the 450,000. Underline that, font group, underline, and that'll give us our profitability index, or the PI. That's going to be equal to then the 598,818 divided by the 450. Let's add a couple decimals, and then there it is, 1.33. Now this one, so see what we're doing, we're basically taking into consideration the value of the investment. So we got the investment and the net present value compared to the amount that we're putting down, which kind of is an attempt to take into consideration the fact that we have different sizes of investments here. And under this analysis, typically we take the one that is higher. So notice that now we can have an excuse not to put down the 450. Now we're like, see, like, it's not just that I'm scared to put down 450 here. Actually, even though the present value would say that this one, like the second one, would be better, when you take into consideration the profitability index, then the first project is better. So it's not just that I don't like putting down that much money, or that worries me. It's the fact that that's what the numbers say. That's what the numbers say. So under the profitability index, we would be putting down then, we would pick project A, even though under the net present value, we would pick the higher one, project B here. Now, the other calculation, of course, is the IRR. So let's do that real quick. If you want to, the internal rate of return would look like this. This would be the rate to make this cash flow be 0. So that would equal the IRR, shift 9, and then we just pick up the values of the profit stream. So, or the stream, that would be these items. So there we have it, and then I'm going to make that a percent, add a couple decimals. So there is that. So in other words, if you made this cell, I'll do it real quick, this is the 32.01, that would make, actually, if you made this cell equal to that exactly, it would make it 0, right? That's the number that would make that 0. So I'm going to undo that, bring that back to 10%. Let's go ahead and just format this. I'll make this black and white, and let's make this blue. I'll just add this to our worksheet here. So we have that included. And if I compare that to the IRR down below, the IRR here, the equals the IRR of these values, and making that a percent, adding a couple decimals. So there we have that. We'll make that blue. We'll put a bracket around it. And then we're going to say that this is going to be black and white. So there we have that. And if I compare this to be equal to the 2516, that would make this 0, right? That's the rate that makes this 0. Putting that back to then 10%. So there we have that. So if I looked at the internal rate of return, this one actually has a high. So if I looked at the net present value only, note I'd say if it clears 10%, then I would be picking up, I might take on the project. But if 2 projects clear 10%, I can only invest in one. Usually, I would pick the higher one, right? I'd pick the higher one, which in this case would be the second one. And then I might then go to the internal rate of return and say, well, what's the actual rate of return? Because the fact that there's different investments can distort things. And so note that the internal rate of return shows 32.01 versus the 25 down here. So the internal rate of return would actually show that would project 1 would be better if I based it on the internal rate of return. And you can also basically see that taking into consideration the larger amount that's being put into B to get the return with the profitability index, which also would indicate that actually project 1 would be the way to go as opposed to project 2.